Okay, let's dive right into this, because it's a wild story. It's all about the huge difference between what the headlines are yelling at you and what the money is quietly whispering. You know, while the media is painting this picture of a world on the brink of war, some of the smartest folks out there are placing massive bets on the exact opposite.
And we're not talking about small bets. Get this. On a Monday afternoon, right before a huge announcement was expected, some trader, completely anonymous, dropped a $100 million bet that this whole escalating mess between the US and Iran was about to just stop. So you have to ask, what did they know that the rest of us didn't?
Right, so to really get why someone would make a bet that big, first you gotta understand just how bad things looked on the surface. Officially, the two sides were in a total standoff. Their demands were so extreme, it felt like war was pretty much the only thing that could happen next.
I mean, just look at this. They're polar opposites. The US is basically demanding a complete surrender. Shut down your nuclear program. Hand over your uranium. Stop meddling in the region. And Iran? They're firing back with demands for a total US reversal. Get your military out of here, pay us for all the damages, and oh, by the way, give us control of one of the world's most important shipping lanes. You look at this on paper and there is zero middle ground. Absolutely none.
And that's really the key, isn't it? If all you did was read these official statements, you'd be in your basement stocking up on canned food. The whole diplomatic route looks like a dead end. But here's the thing about politics, especially when the stakes are this high, it's almost always a game of public posturing. So this is where it gets really interesting. This brings us to the back channels, because it turns out there was a completely different conversation going on behind the scenes, way, way far away from any press conference or angry tweet.
And that really says it all, doesn't it? Both sides were desperate for a way out of this thing without looking weak. They have to project strength for their people back home, so publicly they're denying that any talks are even happening. But privately, they're scrambling to find an off-ramp.
And this lays it all out beautifully. It's this complex web of mediators. You've got Pakistan out in front doing most of the talking, but they're really a proxy for the real power broker here, China. China's economy gets hammered if the Gulf becomes unstable, so they're working in the shadows. Then you have others, like Egypt and Oman, basically trying to keep the fire from spreading while passing notes back and forth. It's like a global game of telephone, all designed so these two rivals can talk without ever being seen in the same room.
Okay, so if you can't trust what the politicians are saying because they're half-truths and the real talks are top secret, what do? You stop listening to them and you start watching the money. Because financial markets, they don't care about politics or saving face. They only care about one thing, probability.
Check this out. It's a perfect example. The big banks, like JP Morgan, they were predicting oil would shoot past $130 a barrel if a real war started. But look, almost a month into this crisis, the price isn't just under $100, it's actually been falling. The market is basically telling us that the threat of a big, supply-disrupting war is fading fast. And it's not just oil. Take a look at this. This is the yield on the 10-year US Treasury bond. Now, if the market really thought a massive war was coming, which would cause all sorts of inflation, this number would be climbing, maybe towards 5% or even higher. But instead, it's stuck below 4.5%. The bond market, which is arguably the smartest money in the room, is not buying the war story. Not at all. Now, this is one of Wall Street's favorite little tells. It's called an inverted futures curve. All it means is that traders were paying more for oil right now, because of short-term panic, than they were for oil to be delivered a few months from now. They were literally betting that this whole crisis was a short-term blip and that prices would be lower in the future. This indicator basically predicted the whole thing would be over within 4 weeks. And here we are, already on day 25. And then there's this number, 16. That was the reading on CNN's Fear and Greed Index right at the peak of the panic. That's a sign of extreme fear. And here's the funny thing about markets. That exact moment, when everyone is terrified, that's almost always the absolute bottom. It's the point where every last person who is going to panic and sell has finally done it. And you really got to let that sink in. Markets don't wait for good news. They bottom out at the point of maximum pessimism, maximum pain. Why? Because once that last seller is gone, the only people left are buyers. The recovery starts long before any peace treaty gets signed. The smart money is already making its move while the bombs are still falling. All right, let's switch gears. Let's move away from the financial data and into the real, physical world. Because look, you can't fake the demand for thousands of tons of actual metal. If the world was really preparing for a massive war, the demand for industrial stuff would be collapsing, right?
Well, say hello to Dr. Copper. That's what they call it, because this metal basically has a PhD in economics. It's like the nervous system of the modern economy. It's in everything, from AI data centers and electric cars to the wires inside our walls. So the demand for copper? It tells you the real story about what's happening with global industry. It doesn't lie.
And this is where we see two completely different stories being told. In London, copper stockpiles are at a 6-year high. The West is hoarding it, building up a fear buffer just in case. But in Shanghai, inventories are falling off a cliff. Why? Because Asian industry is buying and using copper like there's no tomorrow. That's not a sign of fear. That's a massive bet on a huge economic expansion after this conflict is over.
And that brings us to this number, 330,000 tons. That's the amount of copper the world is going to be short by the end of the year. With all that demand, plus some issues at the big mines, we're on track to need way more copper than we can actually produce. Now, that's not the sign of an industrial world that's shutting down. That's a sign of an engine that is seriously gearing up.
So, okay, let's put all these puzzle pieces together. When you step back and look at the whole picture, it is totally different from the one you're seeing on the nightly news.
When we actually follow the evidence, a really clear story starts to emerge. You start with the public political theater, which you learn to ignore. Then you follow the trail to the secret back-channel talks. Then you see those talks being confirmed by the financial data. Oil, bonds, futures, they all tell the same story. And finally, you get physical proof in the real world from the demand for raw materials like copper.
So what's the big takeaway here? That $100 million bet? It wasn't some crazy gamble. It was a cold, calculated move based on all this data that shows the crisis has already peaked. The de-escalation is basically a done deal. It was just brokered behind closed doors. And the thing is, by the time we hear about it on the news, Wall Street has already cashed its checks and moved on to the next big thing.
And that leaves us with one last, kind of crazy thought to chew on. We just saw how cold, hard market data can predict a geopolitical crisis with incredible accuracies. So what happens in the future when those same market forces become so big, so powerful, that they don't just predict peace, they actually dictate it? What if they can force the hands of politicians simply because the algorithms have already decided the war is over? Now that is something to think about.